Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this video I'm going to continue into part two of the kind of going over options basics and the terminology. So if you haven't seen the first part, I'd recommend go and watch that first because this is following on straight from that. So let's get on with the video. So let's go and look now at a couple of real examples, just so you kind of get an idea of how this works. So now we'll go and take a look at buying a call option for Apple. So here we can see that we're buying the Apple monthly call option on March the 19th with the expiration on April the 16th. So you can do options contracts for different periods of time, but you usually will get the, I normally look at the monthly ones, but I think you can get them up until like a couple of years out. But in this case, we're going to choose the strike price of $115. So remember what this call option is. This is giving us the right to buy shares at $115. So the contract is 100 shares. So we're paying for the right to buy 100 shares of Apple at $115. And this is a kind of bullish trade because we think Apple's value or Apple's share price is actually going to go up. And the benefit of this for us here is that we're guaranteeing we can buy the shares for this price at any point during the next 28 days in this case. And we can see here that our premium for the 115 strike is $7.35. So we need to times that by 100 because one options contract is 100 shares. So then we get to the total amount of 735. And the 735 is the total risk we have in this options contract. We can't lose more than the 735. So now we kind of need to check, well, what point are we actually going to break even on this trade? So to ensure we profit from it, we just need to have the stock price rise by more than the premium which we paid. So in this case, we bought the 115 strike price and paid a premium of $7.35. So we add the $7.35 to the 115 and that gives us 122.35. So this will be our break-even point. Anything above this and then we'll start to be in profit. So we have 28 days for the share price to get above this price. And obviously that then we can exercise our option to buy the shares. So now let's fast forward to the day before the contract's expiration. So now we can see that the current share price of Apple is 134.5. And I'll just also point out that you don't actually need to wait until the last day. You can close out the contract any point during the period, and I'll kind of just touch on that in a few minutes. So this is great because we've got the right to buy shares at $115 because we bought the call option at that strike price. And now we can go straight out on the open market and sell those shares at $134.50. So obviously we're making quite a nice profit there. So let's just take a look at the profit we're going to make from that particular options contract. So you can see the current stock price is 134.5. The strike price that we got was 115 and the premium we paid was 735. So here we take the current price of 134.5 and then we minus the 115 and that gives us 19.50, and this is on a per share basis. So then we need to also remove the premium we paid. So we take the 19.50, remove the 735, and that gives us a profit of $12.15 per share. And of course the multiplier on this is 100 because one options contract represents 100 shares of stock. So we take the 12.15 times by 100 and there we've made a total profit of $1,215. So now we'll just go and look at the other side of it. Now instead of buying the call option, we're going to buy the put option for Apple. So here we are buying the Apple monthly put option, and this is April the 16th with the expiration on the 21st of May. So in this example, we've kind of changed our thesis on Apple. We now actually think that the stock is going to go down, so we're bearish. So now we can see that we're going to choose the strike price of $140. and the current share price is trading at 134.16. So remember, with this put option, this gives us the right but not the obligation to sell shares for $140 anytime before the expiration date on May the 21st. Then we go across and look at the premium. So to enter into this contract is going to be $8.65 per share. So you times that by 100 and then you get to the 865. And once again, remember that we're paying this premium. So this is actually the most money we can lose, and therefore our total risk in this actual options trade. And now let's go and take a look at the point we need to be to break even. So to ensure we profit from this, we need the stock price to fall by more than $8.65 below the strike price we selected. So based on this, our break-even point is going to be 131.35. So this is our strike price minus the premium which we paid. So in this case, we've got 35 days for the share price to fall below our break-even price. So now we reach the day before the expiration, and we can see that the current share price is 127.31. And this is great because now we've got the right to sell the shares at $140, and we can buy them back at the market price of 127.31. And let's go and take a look how that trade looks. So we can see there that the current stock price is 127.31. We bought the strike price of 140 and we paid a premium of 865 for that. So we take the 140 and then we remove the share price of 127.31. That gives us $12.69. Then we take the $12.69 minus the 865 premium which we paid, and that brings us down to $4.04. And then we take that times by 100, which is our multiplier for the options contract, and we end up with a profit of $404. So hopefully those examples kind of made it a bit kind of easier to understand. There's a lot of different things you can go into with options, but this is just kind of a really basic introduction into the concept of options. So now let's look at how you can kind of enter and exit options contracts. So as the buyer, when entering into a call or put option, you need to buy to open the contract. And if you want to close the contract, then you need to sell it to complete the transaction. So to exit, you're going to sell to close. So as the buyer, you might want to lock in your profits before the expiration date. And if you're on the other side as the seller or the writer of the contract, when entering into a call or put contract, you first sell to open the contract. And to exit the contract, you need to buy to close, because remember, in this case, you have a short position. So the reason you would do this as a seller is that you might want to limit your losses before the expiration date. So that's it for the video. I hope you enjoyed it. If you did, please give us a like, and also consider subscribing to the channel as well if you haven't already. And you can click the bell for notifications of when I release new material. Also, let us know in the comments what you think about options. Do you use them more as a trader or a long-term investor? I'm kind of also interested to know about all of that kind of thing, because you can use them for so many different things. I mean, my channel is more to do with value investing, but certainly part of that strategy involves options as well. So thanks for watching, and I'll see you in the next video. Cheers.